Hello, everyone, and welcome to today's amazing event on venture finance trends with Wilson Sonsini, Felicis Ventures, and Pioneer Square Lab. My name is Nicola Corzine, and I'm the founding executive director of the NASDAQ Entrepreneurial Center. And if you're joining us today for the first time, welcome. We're delighted to have you. We are a nonprofit committed to really accelerating access and equity in the field of entrepreneurship, not just because it's a nice thing to do, but because it's a must to do for all the innovation and opportunities out there that are made possible through the remarkable entrepreneurs we work with. And so for you, thank you for all that you're doing in contribution to that cause. Now, as you may have seen in the chat, the NASDAQ Center, along with our amazing partner, Mentor Cloud, have recently launched a very large campaign around mentorship. We know mentorship matters to everyone. It is what has made the impossible possible each and every day in the field of entrepreneurship. And so we want to make sure that our entrepreneurs gain access to responsive mentors wherever you may be based and during this very difficult time. So we would invite you, if you haven't yet explored this avenue and you're looking for some additional support, or maybe you've got some incredible intellectual capital that you'd like to deploy in support of our entrepreneurs, to be able to join in the cause. You're going to see in the chat a link to that application and that platform right now. It's completely free. Just like with everything at the center, it's based entirely on a pay it forward approach. And so we'd welcome your chance to join in and be a part of this movement. We don't do anything small here, just like our entrepreneurs don't do anything small in the world either. So our aim is to unlock 1 million mentor hours in support of more than 50,000 entrepreneurs over the course of the next year. And we hope you'll be inspired to join us in this opportunity and make sure that you connect and support the cause. Now, the next thing that I want to sort of recognize is that because we are an independent nonprofit, none of the work that we do would be made possible without the amazing contributions and donations of those who believe in the center and its mission. So for our sponsors, NASDAQ, Lehigh University, Bank of the West, KPMG, Wilson Sonsini, Woodruff Sawyer, BPM, and NZTE, thank you so much for allowing us to do this work, for allowing us to bring forward education, quality resources, and mentorship for entrepreneurs all over the world. During these times, and actually since inception, the center has been committed to really checking in with our entrepreneurs and find out how you're faring. So I'm going to be launching a couple of polls now that I'm going to ask for all of you to respond to. The first one is to just let us know how you're doing as we're coming out of COVID and we're still dealing with a lot of issues around us from 1,000 different directions. This will help us sort of guide and understand what it is that you need. So I'm going to launch this poll, and if you could just give us a very honest interpretation of, in this moment in time, how are you faring from a wellness level? We've been seeing obviously a rise towards optimism, but still a handful and an understandable need of anxiety, and entrepreneurs who are still just trying to put that foot down on the gas and keep on surviving. So wherever you are in this time, just know that we understand you're not alone in how you're doing, and we really appreciate your ability to sort of connect and share with us. I'm going to give just a moment for everyone to contribute. Thank for all of those who have already participated in the poll. And then I'm going to go ahead and share that result today. We're seeing a good health on optimism today, still feeding through with the majority here, but still a number at that surviving and anxious level. So let me share those results. And while I'm sharing those, I want to sort of set up the next poll, and then the last poll that we're doing today. And this is one that we ask in every single class and every single workshop that we've done for the last 6 years. And that's really asking you, what is your biggest business challenge right now? What is keeping you up at night? Just so you know, the center doesn't have sort of a one-size-fits-all approach to its programming. And so how you answer this poll is going to enable our amazing program team here to go out and source trainers, facilitators, those that can help you get unstuck from that business challenge and back to building the businesses that you're inspired to do. So your responses will show up in the programming that the center puts on over the course of the next 2 to 3 months. So help us get smarter with what it is that you need us to be providing for you in these times. Thanks for all of you filling that out. It's great to see, not surprisingly, a high number thinking about finance, sales, and scaling, as well as team dynamics. That has surfaced over the last month too. A lot of people starting to think about resiliency for their team, sort of scaling up their team coming out of this pandemic of sorts, and really starting to build out the businesses that they want to. So let me end this poll, really quickly share the results. Thank you again for the contributions there. And now let's get to the topic at hand. There is a lot of great content that we are going to be covering today around demystifying the trends that are happening around us in venture, the name of the game for sure today. And so without any further delay, please join me in giving an incredibly warm welcome in the chat to our first guest, Craig Sherman. He is a dear friend of the Center, is a partner at Wilson Sonsini, and he's here to share some of the insights from the most recent Entrepreneurs Report at Wilson Sonsini. Craig, over to you.
Great, Nicola, thanks very much. Sorry, my wife is running around, but she's heading out to play tennis shortly. I'm going to go through a couple of charts here. We track on a quarterly basis, and those of you who have listened in before will have seen some of this before, and it will look familiar. But on a quarterly basis, we look at all of the venture deals that we've been involved in and track various deal trends. And I think if you look at the deal trends, the 4 slides that we're going to go over here, I think the overall theme is kind of Jim Morrison and the Doors, "Girl, we couldn't get much higher," for those of you who are Doors fans. And I'm not sure that Jim Morrison was talking about venture capital back in the 1960s, but if you look at these charts, this shows the number of up and down rounds on a quarterly basis over the last 5 years. And the number of up rounds is at a record high, over 90%. This means financings that are at a higher valuation than the previous round. Why don't we jump to the next chart? So looking at median pre-money valuations, on the left side of this chart, we've got the last 5 years, year over year. And on the right side of the chart, we're looking at that on a quarter-to-quarter basis over the last 2 years. And what you can see is astonishing, although for those of you who follow the news, it's probably not surprising that in 2020, the median pre-money valuations have gone up substantially. The full year 2020 Series C and later rounds, the median pre-money valuation was $315 million versus $200 million the prior year. If you look at Q4 of 2020 alone, it was at $462.5 million pre-money valuation. So valuations have gone up substantially. The increase has been less substantial in earlier stage financings, but even Series B, the blue bar in this chart, you can see that median pre-money valuations were at a record level, $96 million versus $66 million the year before. When you get down to the earliest stage financing, seed financings, those numbers are still high by historic standards, 9 million, but the same as the prior year. So the earliest stage financings are still primarily at the same level that they were in the prior year, and that's been creeping up steadily over the last few years. Why don't we jump to the next slide? And then the median amount raised, not surprisingly, companies are raising a lot more money. And similar to the last chart, if you look at Q4 of 2020, the median amount raised was $70 million, which is almost double the prior high in Q2 of 2019 of 40 million. And if you look at the full year numbers, it's not nearly as high. The Q4 was way above the year as a whole, but still record levels for the full year of 2020. We're obviously already through Q1 of 2021, and we'll be coming out with our quarterly report for the first quarter of 2021 shortly. I've already seen a preliminary view of the numbers, and these trends are continuing. The numbers are all continuing up and to the right. Why don't we jump to the next chart? And finally, bridge loans for companies that are raising money either before their first priced equity round, or for companies that are raising money in between financings, a post-seed bridge. So the blue bars on these charts are the pre-seed bridges, an initial convertible note or seed or safe financing before the first priced equity round. The red bar is for bridge financings, convertible notes, safes, all pretty much the same thing in between rounds of financings. And again, you see that the numbers are all up and to the right. Not necessarily at a record level for the Q4 of 2020. You can see that it was higher in Q3 of 2019, but still lots of money going in to bridge financing. So the market continued to be hot in 2020. The market continues to be hot in 2021, and we haven't really seen a change to these trends yet. All is rosy and good.
Well, on that incredibly positive note, I think we get a lot that we get to sort of discuss around the flow of capital and maybe some of the shifts as well that have been positively influenced as a need to do business differently through the pandemic. And so on that note, I'm really thrilled to introduce our other two amazing panelists joining us today. First up, we have Victoria Traeger, General Partner and Managing Director at Felicis Ventures. Victoria, fantastic to have you here today.
Thank you.
And Greg Goetzman, Managing Director and Co-Founder of Pioneer Square Labs. Greg, great to have you too. Perfect. And I think we get that mute, bro. You got it. All right. So it's always the way, isn't it? So looking at those charts and being influenced positively with some good things that are coming out of a very challenging time for a lot of people. I want to stay on that trend just for a moment. And Victoria, maybe I'll invite you to kick us off on saying, innovation has changed as far as a recognition of where it's showing up in this country and across the globe. Can you talk a little bit about some of the insights that you're getting around where are deals happening right now and where is innovation in our country?
So thanks for having me. It's great to be here my first time, and excited to be in particular on with Greg, who will be able to, I'm sure, add a lot more color to the Seattle area. But what I would say that we've really seen is Felicis has always invested in companies that are going to be global leaders, and some of them, for example, have been in Sydney, companies like Canva and CultureAmp, Shopify in Canada, and have just invested all across the US. What we saw happen during the pandemic, like we have seen in general, is just massive acceleration of that shift, with more talent moving to different and attractive areas to live in, such as Austin, global, other parts of the world, certainly Seattle, LA. And as a result of that, there are some newer markets that see bumps. So Seattle has always been a top market for funding, but it actually had one of the highest increases. It went up 2.6x from 2017 to 2020, ending in about 4.4 billion in funding, with 10 unicorn rounds for the Seattle area. I'm actually very sad we were not involved in those, but need to be in the future. So huge market. And then Austin and Denver, those are areas where we have quite a few incredible investments, saw about 2x increases. Same with the Sydney area. Sydney was up, 2 to 3x. And then we saw some newer markets really see incredible growth. One was Philadelphia. Philadelphia was up kind of 3x, a little bit of a surprise market that came out of nowhere. And then globally, Berlin saw tremendous growth, and also multiple Latin American markets. And so we think this has been one of the most positive developments coming out of COVID, is this growth in innovation centers that are outside of the Bay Area.
Oh, we love that rising of the innovation economy worldwide, and recognition of that talent where it is. And speaking of a lot of recognition of talent, obviously, as Victoria set us up, Seattle, there's lots of reasons to love it, from the coffee to the culture to the people and the food, and also now some great unicorns that are obviously being recognized out of there. Greg, tell us a little bit about what you're seeing as far as trends in your region, and perhaps maybe sharing a little bit more on top of what Victoria was saying as far as where deals are happening right now and what it takes to get them done.
Oh, you're muted, Greg.
It's been a very positive time, as Craig alluded to in his in his summary of the financing details. Just to take a step back, because I think what a lot of people are wondering is why so positive? Why is so much of this? Why are there so many financing? It's as frothy of a market from a financing standpoint, as I've been doing this for almost 25 years, as is working with Craig and also with Victoria over many years. But it has been it's been a crazy market. I think when you have this much liquidity being poured into the market from the Fed, trillions and trillions of dollars, and then going into the bond market, buying bonds, making the price of bonds go up. When the price of bonds, then asset allocators are looking for other places to put their money, so they put money into the public markets, NASDAQ, other things like that, and those prices get high, and then they look for other things like real estate, and then also then venture capital and financings. And so we're all benefiting right now from a massive liquidity surge, and my sense is that that's not going to change for a little while here. So feels like they're going to keep pumping more money into this economy, and I think it's going to continue to be a very healthy market for the foreseeable future. At some point, this will come down, as it always does, having been through some, in 2000, 2008. At this point, it's a very positive market. In terms of other places, I mean, Seattle is a fantastic place to build technology companies, and you can build technology companies now from anywhere. And one of the, we're all really fortunate to be riding on the backs of great companies like Amazon Web Services and Azure, and you can build incredible technology from almost anywhere. And I think we benefit from that in obviously in Seattle, but we do all over the country. And so we're seeing great startups from places that normally you wouldn't see them. And I think that trend will only continue and only be accelerated by what we've seen in this pandemic.
Amazing. Well, speaking of acceleration, I think one thing that has always sort of been a bit of a fine art meets science world is when it actually comes to figuring out the speed or the amount of time that it may take from the point of outreach to the point of closing the deal. Craig, obviously you see at a very high level, and also at the individual deal level, some of those nuances right now. How has the pandemic affected sort of speed and velocity of deals? And then if I could ask you sort of a follow-on question from that, for first-time founders who are sort of sitting there about to begin that journey, what should they be thinking about when it comes to sort of setting expectations for the process as a first-time founder versus maybe somebody that's getting follow-on financing at this stage?
Yeah, and I think Nicola, I think that's a really important distinction to make. For the late stage financings, I have not seen things move this quickly since late 1999. And I remember in 99, I had a client that met with a VC the week before Christmas, and we closed the deal before the end of the year. We closed the deal from the first meeting to money in the bank was about 8 days with Christmas in the middle. And that felt like a sign of peak market. If that's a sign of peak market, things are feeling very much like that right now as well, that we've had a number of deals at whether from Series A to SPAC deals, where from first meeting to signed term sheet was a matter of days to weeks at the most, money in the bank within days to weeks as well. So diligence is much shorter than it is in normal non-frenzied periods, and deals are getting closed much more quickly. That being said, I think it is very different for a founder raising first institutional money. Victoria and Greg ought to talk about this in a minute, but it's when a VC is investing in a company for the first time, they're really investing in the people, they're investing in the founders, and somehow we're still getting lots of deals done where for the first time, often money is being wired without the investors ever having met the founders in person. And that's kind of extraordinary that these decisions are being made about writing large checks without really shaking someone's hand and looking them in the eye. Yet it is happening. But I think the fact that you can't meet in person is it certainly is not accelerating those first round deals. The deals that we're seeing that are getting done super fast, first meeting to money in the bank, generally are not deals where there wasn't a prior relationship. And often that prior relationship that really accelerates the process is a relationship between existing investors in the company and the investors who are going to lead the new round. That's where things have been moving extraordinarily quickly.
Yeah, yeah, and that's such a great point to sort of twist into asking Victoria and Greg maybe to weigh in a little bit. You are getting tons of pitches all the time. Doing anything well on Zoom seems a lot of like sort of figuring it out as we go. What advice or suggestions can you offer to entrepreneurs as they really start to try to form relationships through Zoom, like we're all having to do kind of even in these moments? But obviously the stakes are so much higher when they're worried about making that right impression. What guidance or offerings could you give to them, Victoria, as they're starting to think that process through?
Sure. So LinkedIn, make LinkedIn your friend. Spend a lot of time there. But seriously, I would say two key areas to focus on for getting the right introduction to the right VCs. First, as much as you can, try to do a warm introduction, and go through LinkedIn, identify the VCs that you like, and then think about who in your network in second degree connections has that introduction that they could make to the VC. We do think that in this time, especially if you can't without that face-to-face, getting the warm introduction is very, very helpful. So that's kind of obvious. And then, the two other things that I think are practical and have seen be quite effective. One would be to have, many of our top teams and founders, they ran a function at a larger company. And so chances are, if you were at Microsoft or Amazon or another company, you hopefully have a good relationship with the leader of that team, the CEO of your company. We've had some CEOs email us recommending the team that just spun out to start a new company, and we take that pretty seriously. Even if we don't know that CEO, we're probably one degree separated from the CEO. So that would be the second piece. And then the third that I have seen work is founders that do a really good job with thought leadership in their market and their category, and they start writing quite a bit on LinkedIn, LinkedIn articles, even better thought leadership pieces that get published in Forbes, and they start to build a name for themselves as experts in their category. That is another way to really raise your profile. So those are kind of the big three that we see work. How about you, Greg?
Well, I think the warm intro is such a great piece of advice. I think realistically, I've done probably over 250 deals. I think I can, on one hand, count the number of times I've done a deal without sort of a warm introduction. So that's part of the first test of being an entrepreneur, is trying to figure out how you get a warm intro into the right kinds of investors. And it's just it's a bar. And I like Victoria's suggestions there. Great storytelling. Nicola knows this probably well. It has been the same since the time of of cavemen and cavewomen. And so I think being able to, on Zoom, I think you still have to be able to tell a really good story. Focus on your strengths. I think a lot of times I've noticed I used to have hour meetings when they were in person. Now most of my meetings are 20 or 30 minutes because Zoom is just more efficient and there's a little less of that. And so you've got to be able to tell your story more quickly, more concisely, more crisply. And the question I'm asking after a meeting, I just had a great pitch this morning. And the question that this team answered was, what are you best in the world at? What are you best in the world at? And if at the end of my 20 or 30 minutes, if you haven't answered that question very concisely or crisply, then you haven't done your job as an entrepreneur. So by the end of that meeting, I want to know what's your best in the world. And then second, why were you put on earth to do this? So what does this company do better than anyone else? And then why are you uniquely suited to sort of make that happen? And that's just, again, part of that is you can personalize that second question as part of your story. That can be very meaningful. As part of that first question, it doesn't have to be boil the ocean. It could be a very narrow sort of wedge into a really interesting market, but you're best at that. And then you're going to sort of grow it bigger. But again, I think for most great startups, they can answer that question, what are we best in the world at? And the investors can by the end of the meeting, and everyone at the company kind of has a good sense of that. Hopefully that's helpful.
I love that. I love that. Those superpower strengths, and also just both of you sort of leaning into saying, we want to know the personal story. We don't want it just to be about the numbers. I mean, like, yeah, we're going to need to get there and get there quickly and efficiently, but don't disconnect who you are as founders. Let us see that even in a Zoom setting. So I guess, maybe a little bit on that note, Greg, I ran over sort of the story and the incredible story of PSL. Could you take maybe just a minute or two to walk us through? Everybody thinks about value-add investors. You have a really unique philosophy around how you help enhance and bring to life great technology, great founders, great solutions needed in the world. And then maybe on that, if I could ask you to share a recent example or two around how that has actually come to life in the pandemic, maybe a recent deal where that partnership, that collaboration has really made a difference.
Well, I think what you're getting at is, so we at Pioneer Square Labs, we're both a startup studio and a venture fund, and so we have a venture. We have about $200 million roughly under management in terms of venture fund side of things, and then on the but we also spend a great deal of time building companies from scratch. And so far, we've spun out 27 companies that have been venture funded. So we spend, we're there building companies from the ground floor. Some exciting companies that we've built, that sort of are to your question. I'm thinking of one called June, which I love, JOON, which is focused on mental health for teens and focused on anxiety, depression, suicidal thoughts, eating disorders, other kinds of things. And that is a company that we started in the studio. It's a fantastic founding team and attacking a real problem that's been exacerbated, unfortunately, by what's been going on during this pandemic. And I know mental health is something we can spend a lot of time talking about, but it's especially hit the young adults and teenage population hard. And so that's what I'm really proud of, and it's doing extraordinarily well. And unfortunately, the demand for that service is very high. Another one was just we just had a board meeting that we started was Boundless, which is the world's largest online immigration service. And that, again, and that's not as pandemic related, but obviously with the change in administration, I'm really excited about the opportunity for a company like Boundless to be successful with a different policy towards immigrants that this new administration is espousing. So we've been able to take advantage of changes. One of the things about the pandemic is that it creates a lot of change. And anytime there's change, that's opportunity for venture capitalists, for entrepreneurs, for everyone on this call to take advantage of the changes in the market, whether it's work from home, AI, machine learning, all these great things that have been changing so fast. And so one of the nice things about having a studio model, in addition to a venture capital fund, is we can take advantage of some of those changes and build companies to sort of focus on interesting areas that we think where companies need to be built. Hopefully that's helpful.
That's fantastic, and congratulations on such an impressive portfolio, bringing so much needed solutions in the world, for sure. To go back to June for a moment, because I know this was an area that came up in our prep call, and it's one that I think all of us here are really passionate around. We know the journey of an entrepreneur is often lonely. It's incredibly difficult. Ironically, just because you're quote unquote externally successful does not still mean that you're not dealing with a lot of incredible stresses that are being kept on the inside. I know wellness matters to both of you as you think about that journey of the entrepreneur. Would love to just kind of invite your thoughts as we think through this pandemic and sort of the criticality of that issue facing our entrepreneurs right now, how you're addressing it, what you've been inspired by, what you wish maybe there was more of when it came to support for our entrepreneurs. And that's open to the panel, whoever would sort of like to take that and share thoughts.
Sure, I'll kick it off a bit. I think this is such an important area to talk about, and we don't spend enough time talking about it, because anyone who has ever scaled a company and started a company has been through really hard times as part of that journey. And it is actually surprising to me on the opportunity side that there aren't more support resources for CEOs and founders, such as YPO, 10X CEO. Those are kind of the two that for founders that really want that ecosystem of other founders. Those are the two that we promote and actually pay for. And I'm going to get to the what Felicis is doing about this, but I do think that is an opportunity area. It is more collaboration specifically for founders. What we see, so Felicis does a lot of research with our founders. We have over 300 companies that we have invested in. And what we consistently saw is that founders did not want to spend money on themselves to take care of their wellness and their well-being. They wanted every penny to go into hiring and into their companies. And yet we know all 4 GPs at Felicis are former operators. We know how hard this job is of being a founder. And so we started the Felicis Founder Pledge. And what that means is that we commit 1% on top of our investment of non-dilutive capital comes out from Felicis that goes toward supporting founders in mental health. So that's everything from mental health and leadership coaching. So the majority, we have about 100 founders in the program. They're using it for things like therapy, all types of therapy, leadership coaching, one-on-one leadership coaching, and then the CEO circles, 10X CEO and YPO are the two that are the most common. And during the pandemic, what we've actually seen is kind of dramatic shifts in the concerns of founders and what has been driving them stress. We also do monthly roundtables with all of our founders. In the beginning, it was around kind of conserving cash, potentially needing to lay off employees, figuring out how to do bridge rounds for some people that in the first 2 months of the pandemic, we had some founders had a tough time raising capital. And then now the concerns have completely shifted. They're more around hiring the right talent. And also, since everyone has adopted remote, one of our most common questions we get is culture. How do I drive that closeness for my team when the team is no longer in 2 or 3 locations, much less 1, but now is spread all over the globe? Some of the best engineers are off working in Latin America or Mexico, and they're super happy there. So how do you bring that cohesion of culture? And we believe culture is critical. So that's a bit of what we see in the pandemic.
Super inspiring. Thank you so much for sharing that, and for that commitment to the founders. We know how much it matters. We really do. Greg, what about you?
Let me just, so I, one of my close friends and a founder of one of the companies that I was involved with, killed himself 2 years ago. And I had talked with him 24 hours before he took his life. And we had a meeting talking about building another company together. So this is obviously very personal. What I just struggle with still is that I didn't see it. I didn't see the pain, maybe the shame associated with how he was feeling. And I just think all of us just need to ask that extra question. How are you doing? And I think so much of this work is transactional, but the best part of this job is when it's more than just transactional. And so to the extent that you're leading teams or other things, just taking that extra moment to ask that extra question and just see how folks are doing, and then to not be afraid to ask for help and to encourage people to ask for help. I still think there's a stigma associated with the mental health. I think we owe it to try to change that. And I love what Felicis is doing, and I'm personally trying to do everything I can to take away that stigma, because I mean, these are tough times, as people have noted on some of the chat here, and I think it's fantastic that people are trying to do stuff, and then I think, but each of us in our own little ways, I think, can do things to make a difference in this area. So, yeah.
Yeah.
Yeah, I would just add, I think there's a perception that there's no crying in startups, and that's just not the case. It's a lonely job being a founder of a startup, and it's hard to find peers you can talk to. I think founders often feel that it's a sign of weakness if they approach their investors and say, "Hey, I'm struggling, not just with certain aspects of the business, but certain aspects of my personal life." And I think a good investor will be helpful to a founder, and help lead the founder in the right direction if that founder is asking for help. And I completely agree with what Greg and Victoria are saying. People need to trust each other and need to confront these issues rather than hiding them.
So, not to become transactional, but obviously there is a lot of transaction that goes behind the scenes in venture investing. And I think maybe on that note of the importance of transparency, and no question is bad. No worry out there is not deserving of the right to have that worry. Valuation is so often top of mind every time that we're connecting with entrepreneurs. A worry of like, am I good enough? Am I getting the right amount? How do I even broach it when I'm asked about it? You all three have guided so many entrepreneurs through that very delicate power balance, if you'll indulge that term, and also the uncertainty for first-time founders bridging that. A couple of questions, if I can, and again, feel free to take this in whatever direction you'd like. First is, what are you being inspired by when it comes to valuation conversations and discussions in the pandemic? And two is, what have you been delighted to see with the entrepreneurs that have been pitching you that has worked well in positive valuation discussions that any of our entrepreneurs might be able to learn from today? And Craig, obviously that also goes on the client side without naming any names, to the extent that you can sort of share any positive experiences there too.
Yeah. Oh, Greg, go ahead.
No, I was going to say, I want to hear what Craig has to say about this.
Well, I was going to say, Nicola, that I think it is a delicate dance, as you said, and a VC often will ask founders, "What do you think your company's worth?" And early stage founders often think, "Well, I should be looking at my multiple of next year's earnings, which are zero, or my multiple of next year's revenues, which is zero." And hopefully your valuation isn't a multiple of that, because you'll still end up at zero. And you need to realize that, particularly at the earliest stages, it's kind of a backwards math exercise. And you should be looking at the amount of money that you want to raise and the percentage of ownership that you're willing to give up. And that will lead through backwards math to the pre-money valuation. And in this current market, with looking back at those charts, you can see the dollar amounts going up have been increasing dramatically, and the amount of dilution, also the amount of the company that you need to give up in each round, has also been declining. That again leads to those higher pre-money valuations. So when you typically will be asked by an investor, and they're testing you a little bit, what do you think your valuation is? And you ought to dance around that question and not say, my valuation is $6.832 million based on the following mathematical formula, because it is an art, not a science.
Yeah, just to be very tactical, because I think Craig gives some great advice there, but with his backwards math, typically a round's going to take roughly a third of the company. And it's not, maybe it's 20 to 40%, but it's, just for easy math, it's a third. So if someone said, how much are you what's the valuation? You might say, well, we were thinking about raising $2 million, and we want to give up 20% of the company. You could say that would be one one way to address it without getting very specific. And then you can back into what the valuation would be. But that's typically that. So if someone says to me, I'm raising $3 million and it's really early, I have a backward sense of exactly how much they're thinking the company's worth. It's probably going to be worth something like $7 million pre-money is what they're thinking. Because that's roughly 30% of a post money of $10 million. So when Craig says backwards math, tactically what he's saying is that's the way most venture capitalists think about it. Now, if you're going after angel investors, typically then it's a little bit different. And a lot of times you will have to do something like set the valuation for them because they may be less equipped to do all the sort of valuation exercises. And so in those cases, what you want to have is a great lawyer like Craig to help you sort of say, well, what is a standard bridge note type term? Just what sort of market for where we are at this point, and then you can sort of set up a bridge note that would have a valuation attached to it, and go raise money on that with angel investors. Because with that particular group, we're not sort of professional investors quite as much. Then you might want to set valuation. But Craig is right; you don't want to do the job for the venture capitalists. You might tell them how much you're raising, but then dance around what the actual valuation might be with this backwards math kind of idea.
Victoria, anything?
Yes, I mean, such great feedback. The only thing I would add would be more when you're raising A or B rounds. I would say don't obsess about valuation. In the end, valuations are going to be set by the market, and what the founders that I see have the most successful rounds are thinking instead about two things. One, the partner, who's doing the funding. The reality is you're basically getting married. You're going to be together for the next 5 to 10 years, talking and texting almost every day. So I think there's so much, that is a whole separate topic of how do you select the right partner. I would put a lot of emphasis on that point. And then also the market. Many times the valuation is heavily driven by the market. For example, right now, DTC companies very much out of favor, negative valuations, SaaS companies, sky high valuations. But really think about your market. Is it critical need? Make sure it's not a fad. Make sure that you have unbelievable founder market fit. You're doing something where you have specific experience in this market and you're the right founder to bring that solution to market. Those are the companies that are getting multiple term sheets and incredible valuations. So that's more how I would approach it outside of angel rounds, where I completely agree with Greg.
Okay, that's it. That's my new favorite term today. Founder market fit, that amplifies sort of what Greg was saying around superpowers, identifying them, really why you, why now. It's just awesome.
Yeah. Yeah, we always, by the way, one of our questions we always ask is why now? You would be surprised by how many people get stuck on that question. But as you're starting your company, really think about this. Think about the macro factors that are happening and make sure that the market is big enough. One of the other things we often say is the market always wins. So think a lot about the market that you're going into.
Yeah, really, really sage advice. We're really lucky to have the perspectives here around the room today that also have been operators as well as now remarkable value add investors. Looking through the lens of operators, we often are asked the question, in fact, I've seen a couple in pre-submitted questions and even here today in chat, that sort of tries to decide whether or not to raise more money, to raise the ideal money, forget more money, but to raise the ideal money and potentially take the hit on the valuation up front, or to sort of stage it and stagger it. To lean in a little bit to the operators' brains that are here today, how did you sort of think through that decision when you were trying to figure out, do I raise what I just need? Do I raise more than I need? What is that right sort of sense? And then again, perhaps in current environments, what are you sort of using as frameworks right now for guidance of gut checks of like, is this enough money when a founder is pitching me for what they're trying to do?
Yeah, great question. I think maybe start with Craig on that one, because you can sort of paint the context and then we'll jump in with specifics.
Love that. Greg, you're up first.
Craig, I'm calling on you, cold call.
When I got cold called and I wasn't expected to be cold. She said for operators. I'm not an operator. I'm just a lawyer.
Oh,
So
well,
you are the
maybe,
aggregator
sorry,
of
maybe what you're
operators.
saying.
You are our
Yeah.
aggregator of operators here. Sorry, you're still on the hook.
Oh no, well. Now, Nicola, you need to rephrase the question because I was looking at the next round of questions because I had moved on to
It's not a worry.
looking at questions for the.
Yeah, the question was sort of, when we think about frameworks, once upon a time, it used to be raise 6 months of spend, try to figure out what your next major milestone needs to be, kind of be in that barometer. But a lot of our founders, especially again, back to that first time founders, are worried about, do I raise less money and take less dilution now and just hope for the best? What are you seeing as sort of general trend lines out there right now with how much money is really going into that first round and what that stands for, like from the modeling perspective, if you can?
Yeah, I would say for an early stage company, I think the general rules haven't changed, that you want to raise enough money to get to the next milestone that will allow you to raise more money at a meaningful increase in valuation. And usually those milestones are 12 to 18 months away at the longest. Because the model continues to be the same that it's been for years, that you need to prove it in order to raise the next round. And if you can't prove it, you're either going to do a down round financing or you're going to sell the company for scrap. And I think that model's worked well for VC for decades. And I don't think that model really has changed as a result of the pandemic or anything else.
Yeah, I appreciate that. And then I guess speaking to some of the questions that have come in on the chat, Victoria, Greg, I don't know if you can share anything around companies that have had to pivot within the portfolio or maybe pivoting in this time to sort of still figuring out what is my revenue stream or where am I heading to? And does that change the trajectory of how much cash they really need to raise in order to sort of figure out this pivot phase that they may be going through too?
Go ahead, Greg.
No, go ahead, Victoria.
On the amount of cash to raise, we always recommend at least 18 months to 2 years, because you want to give yourself enough runway where you will be raising the next round at around 1 year of cash in the bank. You do not want to generally get down to 6 months. That's a little bit of a negative of you haven't quite figured out the model. Either you haven't figured out the model, or there isn't enough customer and market pull for the product. So that general recommendation across sort of seed and A stages is 18 months to 2 years. And then that should cover both any kind of pivot that you're doing during that period of time and getting to your key milestones. I will say one of the things I don't think we talk enough about, and I'll mention it because it is something that we look at, is revenue efficiency, which is basically a ratio of this is more at the A stage, what is the company's revenue versus the cash that they have burned to get there, to get to that point. So capital efficiency. And we see that it's a symbol of many different things, including the level of market pull for the product, also how efficient the founders have been in building the business. I say this because I think there's somewhere in there was a question around kind of best advice for founders, and I can't tell you guys how many decks I have seen where the company is 0 to a couple $100K in revenue, which is fine, they're early, but they'll make it front and center that they've raised like 7 million from VCs and spent most of that. That's not a positive. So think more about, what's the giving yourself 1 year of cushion. What's the amount that you need to raise that allows you to test into different business models, different customer segments, different go-to-market models, where you can really prove that out for example, from seed to the A stage. Raising, and in particular spending a lot of VC money, we don't think of as positive.
Yeah, having done 1,000 or so financial plans and certainly looked at thousands more over the years, what I can tell you with 100% certainty is that not a single one of them has been right. and even close, especially when you're at the early stage. So all you know for sure when you're building your financial model is that it's going to be wildly wrong. You just don't know in which direction. And so what most good investors will be looking at are the assumptions behind your model, the assumptions behind how much you're trying to raise, and then thinking about, hey, here's the things I want to try to prove with this amount of money, and so as you're building these models, as you're thinking about how much money you're going to raise, give yourself some cushion to be wrong, because you will be wrong. Again, you might have upside surprise, but the chances are that that there are going to be some changes in the financial model. So trying to sort of get it down to the specific dollar amount, as I know sometimes first-time founders do, it's very difficult to do at the early stage.
So just staying there for a moment, and we're going to get to as many questions as we can in the chat and the Q&A. Thank you all so much for participating. Feel free to continue to dump them in there. We'll try to get to as many as we can. But let's talk metrics for a moment. So we know we're not paying attention to the financials because they're going to be wrong. We know the logic model behind the financial matters matter. We know the founders matter. What other metrics are you looking at right now? What are the deals that have gotten done and the metrics behind those deals that have gotten done that you say, yeah, consistently we look for those kind of impact measurements to drive results?
I'll share one good one. So I won't say the name of the company, but this is a phenomenal founder who identified she ran an area within a large company, a large SaaS company, identified a problem, and then went out to build a company to solve that problem on her own. When we met her, by the time we met her, she had, this is seed round, she had 10 term sheets. And one of the things that was so unique about her, it was two things. One, she knew this market cold. She lived that problem at her company. And so I really can't think of a better founder to go and start the solution that she started. But then the second piece is that even though it was a seed deal, she had very specific data around a customer and market need. So she data on 100 customers, potential customers that she brought to the meeting. And she both had survey data, and then she had summaries of one-on-one interviews. So and they were generally decision makers. They were the buyers. So the data was very specific. Furthermore, she is now she's gone on to a couple of rounds since then. Many of those customers or potential customers have gone on to become real customers. So really think about how can you show investors some early signal that there is a there for this market.
The one thing I would say that the area I focus on in terms of metrics is I really dig into unit economics. I mean, I'm obsessed with unit economics. So how much does it cost you to acquire a customer? What's that customer? What's the payback going to be in terms of how long does it take to pay back for that customer? What's the lifetime value as best as you can assess of that customer? And really trying to think about the unit economics at that level. Again, I think you can sort of have these high level metrics, but if you can really bring it down to sort of how much does it cost you to acquire a customer? How long does it take for you to pay back for that customer? If you can even have just those two quick little things, those can be super helpful, especially for an early stage company.
I love that. And again, it goes back to being that expert founder. Why you, why now, giving you reason to be able to share on LinkedIn your expertise and have others follow you, attract great team members. So you guys are just dialing it in, bringing it all the way home for all of our entrepreneurs today. Thanks so much for that. Look, one of the things that also I feel like isn't talked about a lot is the challenges of last year certainly highlighted some issues around social justice in this country and globally as well. How is the venture industry, from your perspective, sort of showing up in this past year around the challenges that were highlighted? What have you been pleased to see from a response mechanism? And maybe if there's more to be done there, what are your firms sort of thinking through in this time and as we enter into hopefully a better year ahead for all of us?
Maybe I'll kick us off. I think that, first of all, the events of last year were, in my mind, very much about awareness and shining a spotlight on the level of inequality. And since then, and even before then, we have seen some incredible groups organize into ways to make a difference and to change this inequality. I'll call out a couple that we work with closely. I'm super impressed with a group started by Malin Yen called Operator Collective. So Operator Collective, 90% of their LPs are women and 40% are people of color. We work very closely with Operator Collective and have led several A and B rounds from the investors, from their companies. But the important thing is both their LPs and the companies that they're looking to fund are opening up the world of venture to people of color. Teresa Gao also recently started a new fund that she raised with Sukhinder that is focused on both LPs and founders and expanding capital to people of color. And then we are active supporters of a group called Black VC. And in fact, Toby on the Felicis team is a part of the organization. And I think they've really done an incredible job of opening up awareness, opening new chapters, like they're getting ready to open an Atlanta chapter, and really changing the narrative and increasing awareness to drive some of this change. But let's also be clear. I think there has been a real shift, but we have a very long way to go.
Yeah, we have a long way to go on this issue, and each firm, each company has to do its part. I think in terms of setting up metrics. If it's important to you, then you measure it. And so what we've done at PSL is we have specific metrics that we're trying to hit around a whole host of issues associated with DEI in terms of, number of founders that folks that we're interviewing, our pipeline. We're looking at trying to be very specific and very metrics driven about it. And let me give another shout out. There's a wonderful group called Visible Hands that I've been associated with. I think one of the areas that is the big issue here is really finding underrepresented founders and making it possible for them to go pursue this entrepreneurial, roller coaster that all of us, on this call have been on. And so I love that group, but it's a group of diverse founders that are really going after it. So that's another great group.
As with everything in entrepreneurship, it is about staying the course and continuing to learn and improve. And I think what you've shared here are just amazing elements to that. I can't believe we're already at time. An hour always passes so quickly in this conversation. Thank you for the transparency, the honesty, and the amazing insights and perspectives that have come out today. It's really been an honor and a pleasure to be able to connect with all of you on this content. To our audience joining us, to our entrepreneurs, our investors, our ecosystem at large, thanks for everything that you are doing. Now, I have one ask of you. Like I say, we can only get smarter by measuring and improving, just like you heard from Greg and Victoria. So please tell us what more you wish we could have covered today. We'll try to get some of that intel gathered out to you, fuel for another conversation, perhaps with this amazing group and others in the future. So please do take a moment to complete that survey feedback. Stay tuned for some of those upcoming programs that you've asked for, that you're co-designing with us in support for everything that you're building out there in the world. And again, to this amazing panel, thank you so much. And if you haven't yet downloaded that Entrepreneurs Report, please make sure you do so today. Thanks, team. Bye.
Thanks for having us.
Thanks
for having us. Bye.